Bismillahirrahmanirrahim. In this video, we will explain the difference between expense and asset. We will also discuss the difference between expense and cost, adjusting entries for deferrals, that includes adjusting entries for prepaid expenses like closing inventory, also called closing stock, prepaid insurance, depreciation. We will also talk about unearned revenue and bad debts. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. So let us start with talking about expense and a asset. Assets and expenses are fundamental components of a business financial operations. Both assets and expenses are purchases that a business makes to conduct its operations. However, they differ in their purpose, how much they cost, and even in recording them. Therefore, it is important that an accountant or a financial professional has a solid understanding of an expense and an asset and how they can affect a business financial outlook. Let us see what are assets and expenses and how to record them in accounting system. Expense and assets, both of them are purchases, but expenses are going to be less than a specific amount and they are made for the operation of a business, to operate the business. A asset is also a purchase, but this is to support the business operations. Typically, they are going to cost over a specific amount, maybe 1,000 or 10,000, whatsoever is decided by the organization. Expenses are costs that are incurred by the business in its day-to-day operations and they are incurred with a purpose to generate revenue. Resources are owned by a business that provide future economic benefits, and that is what asset is all about. Expenses are consumed immediately upon purchase, while assets they maintain value for at least 1 year after acquisition. Expenses are deducted immediately and we don't create any depreciation for expenses. However, assets may depreciate or appreciate over time. Expenses do not maintain their worth for a period more than a year and are usually consumed immediately or within a year. Businesses may have different cost thresholds for classifying purchase as assets. They may be current assets, they may be long-term assets. Examples of expenses are operating expenses like salaries, utilities, rent, cost of goods sold, like that includes raw material cost, production cost, administrative expenses like office supplies, advertising, insurance. While assets, one of them is land, on typically they do not depreciate, but then there are tangible assets like machine, vehicles, and buildings. They depreciate definitely. There may be intangible assets like patents, copyrights, trademarks, goodwills. There may be financial assets that include stock, bond, and cash equivalents. Expenses are recorded on the income statement and represent the use of assets to generate income, while assets are recorded on the balance sheet and contribute to the business value. The income statement shows how a business profits compare to their expenses for a specific period, while assets, when they are reported in the balance sheet, and they show the impact of those on the business financial positions. Expenses are recorded on the income statement as they are incurred during the accounting period. They are recorded in the balance sheet at their historical cost generally, or it may be in fair market value as well. Expenses are subtracted from revenues to calculate net income, and they reflect the cost of doing the business. Assets are classified into current and non-current assets based upon the liquidity and long-term nature of the assets. Expenses reduce the business profitability but are necessary to generate revenue. Assets contribute to the business net worth and are vital for long-term sustainability. Okay. Now, many people use cost and expenses interchangeably, but it is important when operating a business or handling the organization's accounting to be able to tell the two apart. Learning the difference between cost and expenses will help ensure proper management of company finances, and we will distinguish between cost and expenses, including how each is used in business accounting, and we will provide it with the help of an example as well. Now, expenses are the cost incurred in the process of generating revenue and are conducted on the day-to-day business activities we have already talked about. Cost is the amount paid to acquire an asset. Expenses are recorded on the profit and loss statement, while costs are recorded in the balance sheet. Expenses are subtracted from the gross income to calculate the company's net income or profit. In the case of cost, accumulated depreciation is subtracted from the original cost of an asset to determine the asset's book value. Sometimes a cost can transition into an expense as it evolves from an asset on the balance sheet to a necessary business expense. This shift occurs when the cost of acquiring an asset for business operations becomes an ongoing expense. Expenses are usually consumed within the accounting period in which they occur. Cost may have a long-term impact on the business and contribute to its value over time. Expense, as we have said, that it is an immediate consumption or use of resources, typically less than a year. Over time payment for acquiring an asset. For the assets, it is a one-time payment for acquiring it. Insurance bill paid over 6 months remains a cost until it is fully used or expired. So cost can include prepaid expenses like prepaid insurance. Prepaid insurance is treated as an asset until it is used up. Monthly payments, if paid monthly, each payment is considered as a expense, reducing the prepaid insurance asset. Now, we have some common terms that are used in financial accounting and cost accounting. We classify cost under cost accounting into fixed cost and variable cost. Now, fixed costs are the costs that remain constant over the short period of time. regardless of changes in the within the business, like tangible assets like patents, intangible assets like patents, tangible assets like equipment, insurance, fixed interest rate, rent, salary or fixed compensation for employees, utilities. Now you can see that these expenses, these costs are classified as expense in financial accounting. You can see there is rent, we have employee salaries, we have utility bills, there may be marketing expenses, fixed interest, interest expenses, rates on on loan agreements, commissions. Then there may be variable cost, and they fluctuate with changes in business activity. There may be variable cost related to material, labor, or even commission. Okay. Next, let us start with talking about the adjusting entries. Now, adjusting journal entries are necessary when transaction begins in one accounting period uh, but concludes in a later period. They also rectify errors in financial reporting made within the accounting period. An adjusting journal entry is a record in a company's general ledger made at the end of an accounting period to ensure that all incomes and expenses are properly recognized. The purpose of adjusting entries is to record transactions for accurate financial reporting, compliance with accrual accounting principles, ensure the matching and revenue recognition principles. There are three types of adjusting journal entries. There may be accruals, there may be deferrals, or there may be estimates. So these are the key takeaways. The adjusting entries, they occur at the end of the accounting period, transition from one period accounting period to the next. It is important for companies to use when using accrual basis of accounting. This is not applicable for companies using cash accounting. Now, interestingly, we don't use cash accounting for a company. So this is what we wanted to talk about about them, and let me elaborate a little more about accruals, one of the type of adjusting entries. Now, accruals is the recording of revenues or expenses that have occurred but not yet recorded, like accrued interest expense. Similarly, deferrals, recording of revenues or expenses that have been recorded but not yet earned or used. Example like unearned revenue. And then finally, we have estimates, recording the non cash items such as depreciation expense, allowance for doubtful accounts, or inventory obsolescence reserve, etc. So these journal entries, they help to ensure accurate financial reporting by correcting any errors or omissions in the accounting records. They typically involve accruals, deferrals, or estimates to align the financial statements with the accrual accounting principle. In essence, adjusting journal entries are crucial for smooth transitioning smoothly from one accounting period to the next, and for providing a more accurate representation of a company's financial position and performance. It is worth noting that companies using cash accounting method generally do not need to make adjusting journal entries, although as I have already said, I believe that no company may be using cash accounting method. Okay. So accrual accounting recognizes revenue when it is earned or incurred, not just when cash is received or paid. The different components of adjusting journal entries are income statement accounts like revenue and expenses, balance sheet accounts, assets, and liability. The commonly relates to accounts like accumulated depreciation, allowance for doubtful accounts, accrued expenses, accrued income, prepaid expenses, deferred revenue, and unearned revenue. Adjusting entries help to align financial statements with accrual accounting principles and provide accurate representation of company's financial position. Let us look into how to record adjusting entries in case of deferrals. Deferrals refers to cost or revenues that a company postpones recognizing until a later date when the cash was initially exchanged. The purpose of deferral adjusting entries is to record the portion of the deferred item that was incurred as an expense or earned as revenue during the current accounting period. There are two types of deferrals: prepaid expenses and unearned revenues. Prepaid expense is the cost paid in advance but not yet incurred. Adjusting entries are made to recognize the portion of the prepaid expense that corresponds to the current accounting period. Unearned revenues are the revenues received in advance but not yet earned. Adjusting entries are made to recognize the portion of the unearned revenue that corresponds to the current accounting period. The importance of deferral is accurate matching. Deferrals allow companies to accurately match expenses with revenues in the appropriate accounting period, reflecting financial positions. Deferrals help reflect the true financial position of the business by ensuring that expenses and revenues are recognized when incurred or earned. Examples of deferrals are prepaid expenses like rent paid in advance or insurance premium paid upfront. For unearned revenues, subscription fees received in advance or retainer fees received before services are provided. Thus, deferrals play a crucial role in accounting by ensuring accurate financial reporting. Understanding and appropriately recording deferrals help maintain the integrity of the financial statements and reflect the economic reality of business transactions. Let us now talk about the first type of adjusting entry, that is prepaid expense. Now, prepaid expenses are payments made for expenses that benefit more than one accounting period. They are recorded as assets on the balance sheet. Examples include insurance, supplies, advertising, rent, and purchases of buildings and equipment. Prepaid expenses are the costs that expire either with the passage of time, like rent or insurance, or through use, like supplies. These costs are not recorded daily but are deferred until financial statements are prepared. Adjusting entries are made at each statement date to recognize expenses applicable to the current accounting period and adjust remaining amounts in the assets account. Before adjusting uh, prepaid expenses, assets are overstated and expenses are understated. We will look into how it happens. Adjusting entries ensure accurate reflection of the company's financial position by increasing, that is debiting, an expense account and decreasing, that is crediting a asset account. We have already talked about the examples like supplies purchased for future use, insurance premium paid in advance, rent paid for the upcoming months, advertising expenses, prepaid for a campaign. So, prepaid expenses are recorded as assets on the balance sheet until they are used or expired. Adjusting entries are made to recognize the portion of the prepaid expense applicable to the current accounting period. So, prepaid expense play a crucial role in companies' finances by ensuring proper allocation of expenses over accounting periods. Understanding prepaid expenses and their accounting treatment is essential for accurate financial reporting. We will now talk about the first type of prepaid expense, that is closing inventory, and we will talk about the closing inventory for two different types of industries: service and manufacturing. So let us talk about recording the inventory in case of service industries. Now, inventory management may not be visible in the case of service processes as it is in the manufacturing industry. Uh, Inventory management is crucial aspect in the manufacturing sector, no doubt. However, it is a misconception to think that inventory management is not important in the service sector. Inventory is essential for companies in various service industries, including retail, restaurant, wholesalers, distributors, transportation, and logistics. In case of service industries, physical inventory is not prominent. Take for instance a insurance company where physical inventory is minimal, typically limited to stationery supplies. In such companies, supplies are utilized throughout the accounting period. Instead of recording supplies expense as they are used, companies typically recognize supplies expense at the end of the accounting period. At the end of the accounting period, the company counts the remaining supplies to determine the ending inventory. The difference between the unadjusted balance in the supplies, that is the asset account, and the actual cost of supplies on hand indicate the supply used, which is recognized as an expense for that period. This practice allows service companies to accurately account for the utilization of resources and manage their inventory effectively, contributing to overall operational efficiency and customer satisfaction. Let us look into an illustration. Now here Sarah Corporation purchased supplies for 2500 on January 1. An inventory count at the close of the business on December 31 revealed that 1000 of supplies are on hand. So to simplify, when the supplies decrease by 1500, 2500 minus 1500, it means 1500 worth of supplies has been used up. Therefore, the supplies account should be adjusted to 1000, reflecting the remaining supplies on hand. Simultaneously, supplies expense should be recorded as 1500, representing the cost of the supplies that have been utilized during the accounting period. This adjustment ensures that the company accurately accounts for the supplies consumed and reflects the true financial position regarding its inventory. So you can see that we have adjusted our supplies to the actual balance of 1000 by reducing our supplies by 1500 and recording this as supplies expense as well. If the adjusting entries for supplies is not made, expenses will be understated and net income will be overstated. Additionally, both assets and shareholders' equity will be overstated by 1500 at the end of the period. Next, let us look into how to record closing stock in case of a manufacturing industry. Now, ending inventory is the value of goods that remain available for sale and are held by a company at the conclusion of the accounting period. You should also note that the dollar value of ending inventory is influenced by the chosen inventory valuation method. Ending inventory is crucial component in calculating the cost of goods sold. The method chosen to assign a dollar value to inventory and cost of goods sold affects values on both the income statement and the balance sheet. There are three common methods used in valuing ending inventory. It may be FIFO, LIFO, or weighted average. FIFO method assumes that the oldest inventory items are sold first, leaving the newest items in ending inventory. The impact is that in periods of rising prices, FIFO results in lower cost of goods sold and higher ending inventory values. LIFO assumes that the newest inventory item are sold first, leaving the oldest item in ending inventory. The impact is in periods of rising prices, LIFO results in higher cost of goods sold and lower ending inventory values. Weighted average cost calculates the average cost of inventory items based on the total cost of goods available for sale divided by the total number of units available for sale. The impact of using weighted average cost is it provides a middle ground approach and it smooths out fluctuations in inventory cost. I will intentionally not discuss the three methods at this time. Inshallah, we will be talking about them in some future videos. Thus, ending inventory is vital for financial reporting and inventory management. Let us look into an illustration in this regard. The beginning inventory count for ABC company on January 1 was 250. So the beginning inventory is 250. The company purchased 600 units during the year and the company had 150 on December 31st, that is the ending inventory. That means that the total units available for sale is 250 plus 600, that is equal to 850 units. Now, the units sold during the year are the total units available for sale, that is 850 units, minus the ending inventory of 150, that is equal to 700 units. Now, the cost of goods sold will be the units sold during the year multiplied by the cost per unit. Now assume that unit cost is $1. So the cost of goods sold will be equal to 700 units times 1, that is equal to $700. So to record the purchase during the year, obviously that is going to be the purchase. So purchase we will be debiting the inventory by 600. We are purchasing 600. So in the journal entry will be inventory will be debit by 600, and if we have not paid, so that becomes accounts payable credit by 600. But important for us is to know the how to record the adjusting entry for cost of goods sold. And for cost of goods sold, the adjusting entry will be debit cost of goods sold, and we have sold 700, that will be debit, and inventory will be credit by 700. So this entry reflect the inventory transaction and the recognition of cost of goods sold for the year. If the adjusting entry for cost of goods sold is not made, then the expenses will be understated by and net income will be overstated by $700. Additionally, both assets and stockholder equity will be overstated by 700 at the end of the period. Next, let us look into another example of deferred expense, that is prepaid insurance. Now, prepaid insurance is insurance coverage paid in advance to safeguard against potential losses such as fire, theft, and unforeseen events. They provide financial protection and security for companies against unexpected incidents. Prepaid insurance premiums are recorded as an increase, that is debit in the assets, that is prepaid insurance, and premiums are often paid in advance covering periods longer than 1 year. The purpose of adjusting entry is to ensure accurate matching of insurance expenses with the corresponding accounting period, and companies adjust accounts by increasing, that is debiting insurance expense, and decreasing, or that is crediting prepaid insurance, and we will look into it in a minute. The importance of adjustment is number one, accuracy. Adjustments reflect the portion of insurance that has expired during the period, maintaining the accuracy of financial statement. It ensures the integrity of the company's financial reporting by accurately reflecting expenses related to insurance coverage. Thus, prepaid insurance provides essential financial protection for companies. Adjusting entries ensure that insurance expenses are accurately matched with the accounting period. The importance of maintaining the integrity and accuracy of financial statement is critical. Let us look into prepaid insurance adjusted entry. Now you can see that Sarah has paid 1200 for 1 year fire insurance, but she has paid on October 1. So and because they are paying on October 1, that means for the current year the expenses to be recognized will be 1200 for 1 year. So for 1 month it is equal to 100, and for 3 months, because we are buying on October 1, it will be 300. So we have to make this adjustment. Prepaid insurance will be decreased by 300, and insurance expense will be increased by 300, and the journal entry will be insurance expense debit and prepaid insurance credit. You can see that After adjustment, the prepaid insurance balance is 900 and there is an increase in insurance expense by 300. So, if adjusting entries are not made for prepaid insurance, expense will be understated by 300 while assets are going to be overstated by 900, and even the stockholder equity will be overstated by the same amount. Next, let us look into another example of deferred expense, that is depreciation. Now, a company typically owns long lived assets like buildings, equipments, and vehicles, which provide services over the useful lives. They are recorded as assets and not expenses when acquired following the cost principle. To adhere to the expense recognition principle, companies allocate a portion of the asset's cost as an expense during each period of its useful life. The allocation process is called depreciation, where the cost of the asset is spread over uh, its useful life. Depreciation is necessary to recognize the cost that has been used, that is an expense, during the period, and to report remaining unused cost as an asset at the end of the period. It is essential to understand that depreciation is an allocation concept and not a valuation concept. It allocates the asset's cost to the periods in which it is used and doesn't attempt to reflect the actual change in the asset's value. Let us look into a depreciation adjusting entry. Now, Sarah records depreciation on its equipment at 400 and oh, there is an error here. So Sarah records depreciation on its equipment for 480 per year. The equipment was purchased for 5,000. So Sarah records accumulated depreciation on its equipment. Rather directly decreasing the asset, Sarah credits the accumulated depreciation equipment. This account is called the contra asset account, offsetting the asset account on the balance sheet. Accumulated depreciation equipment keeps track of the total depreciation expense taken over the asset's life. To maintain the balance in the accounting equation, Sarah increases the depreciation expense account, thereby reducing stockholders' equity. This adjustment ensures that the balance sheet reflects the net book value of the equipment after accounting for depreciation. The balance in the accumulated depreciation equipment account increases by 480, while the equipment account will remain the same, that is 5,000. Okay. And obviously, if the expenses are not recorded, expenses are understated by 480 and assets and stockholder equity will be overstated by 480. So far, we have talked about the first type of deferred expense, that is prepaid expense. Next, let us talk about the second type of deferred expense, that is unearned revenue. Unearned revenue represent cash received before revenue is earned, like rent, magazine subscriptions, customer deposits for future services, airline tickets uh, are considered as unearned revenue until the flight service is provided. So, unearned revenue is a liability for the company and the accounting treatment is like this, that is cash received creates a liability in unearned revenue account. Revenue earned when services provided recognized during the adjustment, and the adjusting entry is to record adjustments in the earned revenue and the remaining balance to be shown as a liability. Before adjustments, liabilities are overstated and revenues are understated, and the adjusting entry is to debit the liability and credit the revenue for accurate reporting. So let us look into an unearned revenue adjusting entry. Now, Sarah Corporation received 1200 from Arnox on October 1 for guide services for multi-day trips expected to finish by January 31, that is next year. Upon evaluating the services provided to Knox during the year, Sarah determines it earned 900 by December 31. Service revenue earned in the current year is 20,000. So Sarah Corporation, they received 1200 for the guided services. The payment was credited to the unearned revenue. Concurrently, service revenue earned in the current year is 20,000. So upon evaluating the service provided to Knox, Sarah determined it has earned 900 by December 31. So the liability unearned revenue decreases by 900 because this much of the revenue has been earned now, and the adjusted balance of so the liability is going to decrease, and obviously this will be an increase in the revenue, and this increase in revenue will increase the stockholders equity, and the adjusted balance for unearned revenue is now 300, representing the remaining guide services expected to be performed in the future. Without this adjustment, revenue and net income are understated by 900 in the income statement, and also the liabilities are overstated and stockholders equity is understated by 900 on December 31st. And if the adjusting entry is not made, net income are understated uh, while the liabilities are overstated and stockholder equity is understated. Next, let us talk about adjusting entries for bad debts. Bad debts refers to the portion of a company's accounts receivable deemed uncollectible at the end of a fiscal period. It represents the amount that the company does not expect to recover from its customers. Bad debt is recognized as bad debt expense on the company's financial statement. Bad debt expense reflect anticipated losses due to customers' inability or unwillingness to pay their debts. It impacts the company's profitability and financial health. Managing bad debts help in maintaining accurate financial records and making more informed or better informed business decisions. Bad debt expense is typically recorded as an operating expense on the income statement. It is matched against the revenue generated from sales to reflect the true net income. Companies may use different methods to estimate and account for bad debt, such as the allowance method or direct write-off method. Bad debt expense reduces the accounts receivable on the balance on the balance sheet. It also decreases the net income reported on the income statement. Properly accounting for bad debt ensures transparency and accuracy in financial reporting. There are two methods of recording bad debts. Let us first look into the direct write off method for uncollectible accounts. Now, under the direct write off method, uncollectible accounts are charged to bad debt expenses when determined to be uncollectible. This method only records actual losses from uncollectible accounts and doesn't adjust for estimated losses in the account's receivable balance. The impact use of the direct write-off method can reduce the usefulness of the income statement. It may lead to misleading financial results, especially when default rates are high due to increased sales without proper credit approval processes. The method fails to accurately reflect the amount of accounts receivable expected to be received. Accounts receivable might not represent the true value due to unadjusted bad debts expense. For example, a company sold 1 million computers with no down payments on credit approval, experienced high default rates in the following year, leading to misleading financial statements. Bad debts expense may be recorded in a different period from when revenue was initially recorded. This creates a mismatch between expenses and revenues, impacting the accuracy of financial reporting. Unless bad debt losses are expected to be insignificant, the direct write off method is not considered acceptable. It fails to accurately match bad debt expenses to sales revenues and doesn't reflect the true value of accounts receivable. Let us look into a transaction in this regard. Now, Warden Company writes off M.E. Doran's 200 balance as uncollectible on December 12. So, the general entry will be on December 12. Bad debt expenses will be debit and accounts receivable M.E. Doran will be credit by 200. If you want me to show you in the accounting equation, liabilities plus stockholder equity, the accounts receivable is going to decrease by 200 while bad debt expense is going to decrease the stockholder equity by 200. Next, let us look into the second method of recording bad debt, that is allowance method for uncollectible accounts. The allowance method for accounting for bad debt involves estimating uncollectible accounts at the end of the accounting period. This method ensures better matching of expenses with revenues on the income statement and reflects receivables at their cash net realizable value on the balance sheet. The key points about the allowance method are the estimated uncollectible accounts are matched against revenues in the same accounting period when the revenues are recorded. Companies make adjusting entries at the end of each period to record estimated uncollectibles. Estimated uncollectibles are recorded as an increase, that is debit to bad debt expense, and an increase, that is credit to allowance for bad debts accounts. Allowance for doubtful accounts is a contra account to account receivable. Now, when an account becomes uncollectible, companies debit the actual uncollectible amount from allowance for doubtful accounts and credit it to accounts receivable. The allowance method is crucial for financial reporting when bad debts are significant in amount. It ensures that companies reflect their receivables at a more realistic value and provide a more accurate representation of the financial position of the company. Let us look into an illustration. Now, Hampson Furniture has credit sales totaling 1,200,000 with 200,000 outstanding at December 31. That credit manager estimate that 12,000 of these sales will likely be uncollectible. So, to account for the estimated uncollectibles, we are going to make the following adjusting entry. First of all, there is a increase in the, and let me put it in the accounting equation. First of all, assets is equal to liabilities plus stockholder equity. So there is an increase in the bad debt expense by 12,000. An increase in expense will decrease stockholder equity, and there is a bad debt allowance or uh, allowance for doubtful accounts, and this is a contra entry, so that's why this is going to be minus 12,000 again. So 12,000 is a debit to the is a debit to the bad debt expense account to reflect the estimated uncollectible account. So bad debt expense will be debit by 12,000, and 12,000 is credited to the allowance for doubtful accounts, credit by 12,000 to increase the allowance for potential uncollectible accounts. This adjusting entry ensures that Hampton Furniture accurately reflects the estimated uncollectible amount in its financial records, providing a more realistic representation of its accounts receivable and bad debts expense. Companies report bad debt expense in the income statement as an operating expense, typically categorized as a selling expense. By doing so, companies align the estimated uncollectibles with the sales made in the same year, ensuring accurate expense recognition. The allowance for doubtful debts represent the estimated amount of claims on customers that companies anticipate while becoming they anticipate that it will become uncollectible in the future. So instead of directly crediting accounts receivable, companies use a contra account to account receivable account, offsetting specific write-offs as they occur. In the balance sheet, the company deducts the allowance account from accounts receivable in the current asset section, and this practice ensures that the balance sheet reflects a more accurate depiction of the net realizable value of accounts receivable, accounting for potential account collectible accounts. Let me explain how we do that. We have a partial balance sheet, and we have the accounts receivable is a current asset. So we have accounts receivable for 200,000, and we will subtract less allowance for doubtful accounts, that is 12,000. So that makes 188,000. So the amount of 188 represents the expected cash realizable value of the accounts receivable at the statement date. Companies retain allowance for doubtful accounts open at the end of the fiscal year, allowing it to carry over to subsequent periods for ongoing monitoring of potential uncollectible accounts. This approach ensures that companies maintain a realistic assessment of their accounts receivables, net realizable value without closing out the allowance account each fiscal year. So this completes the fourth video where we looked into deferral accounting and we discussed the adjusting entries for prepaid expenses, unearned revenues and bad debts. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.